Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to Pasture to Pin, a new series from the Ever.Ag Insights team. Each week we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Todd Rowen, joined today by my co-host, Trey Freeman, and our special guest and Director of Livestock, Stephen Hardison. Gentlemen, welcome to the show.
Thank you, MT.
Absolutely. Before we get started, let's go ahead and timestamp this episode. It is April 11th, 3:15 in the afternoon. Before we get started with our futures update and hear from our guest speaker, I will go ahead and give us a quick weather update from around the country. We are experiencing rain on both coasts as well as the eastern Corn Belt. Snowpack continues to persist in the northern plains as well as the upper Midwest. For the most part, the drought has largely broken or has at least been reduced in most places, but it seems to be naggingly persistent across the plains regions of Nebraska, Kansas, Oklahoma, and Texas. So with the weather update being complete, Mr. Freeman, will you take us through the futures market, please?
You bet. Last week, cattle futures finished sharply higher on account of the red hot cash cattle prices. Futures have extended those gains into the first of the week, with spot month April taking out the all-time high for spot cattle futures from 2014 and closing above it, settling at 172.30 here on Tuesday afternoon. Spot feeders are following higher, with April sitting at 202.10. Gaps from Friday's sharply higher open remain intact in both fats and feeders. They're anticipating steady to higher trade in the cash market this week. Wouldn't be surprised to see futures attempt to fill these gaps Wednesday while the trade awaits cash to develop later in the week. Moving forward, I'd expect cash to captain the ship higher, with futures following in suit. The two things that really stick out to me most when glancing at cattle futures today, one is the spread between spot month April and June fat cattle. It's now widened to a positive $8.35 a hundredweight. Positive April-June spread. It's nothing out of the ordinary, but with cash trading 172 up to 180 in the north last week, and June futures trading around 164, there is potential to see a rip higher in that June contract should packers need to remain aggressive on their purchases here into the next couple of weeks as we approach peak demand for early summer grilling. The other thing that sticks out is the late summer and fall feeder contracts, trading at such a premium to the nearby April and May, with August through November now trading 224 to 230. A run higher in new crop corn and soy prices that could limit or cap the levels in deferred feeders should dry weather strike and prove perilous to the Midwest. Conversely, much needed rains in still drought-stricken areas this spring could spur heifer retention and further support gains in those deferred feeder futures. Overall, futures know the supply side of the fundamental equation relatively well. They've been building them in. What futures are not pricing in is a waning demand market that hinders demand for beef and the consumer's ability to pay for it. So sensitivity of cattle futures to outside financial markets will remain, and expect volatility moving forward.
Right. Thank you, Trey. That was a great update. Like you said, we just keep seeing cash moving higher. We keep seeing futures follow. It's a little bit out of the ordinary for this time of year as we move into the spring months, which is technically a counter-seasonal move. And speaking of seasonality, this is where our special guest and supervisor, Stephen Hardison, will step in and talk with us a little bit about seasonality and some seasonality charts that our company Ever.Ag has to offer. Stephen, take it away, sir.
Thank you, MT. I appreciate it. So I started out with the seasonal patterns several years back when I had some experience within the federal crop insurance livestock program, just using them to pinpoint highs and lows within the market to help with risk management as it applied to LGM and livestock risk protection. So what we do is it's not necessarily a seasonal average of the prices, but it's of the price range. So we take the data, we normalize it to take out the extreme low or high prices that could potentially overweight that seasonal pattern when you're looking at only prices. And then we expand that back. So what we get is we get a chart of the actual range of price movement. And I can kind of walk you through a couple charts here. Just looking at the May feeder cattle contract, typically what you see is a seasonal peak near the mid-December period. You get in another peak mid-January towards the end of February, and then you see another seasonal high towards April 10th. And then you'll see that really fall off into the May 16th time period as that contract expires. What does that really mean? If we were to take and look at this contract really at the chart, and let's just look at the May 2022 contract, the low was 153, the high was 177.87. And so if I'm really looking at that seasonal index, not looking at a price scale, but at more of a 0 to 100 type index, the 153 would be the 0, the 177 would be the 100. That's about a $25 spread there. And so just looking from the high end of the range there in February, falling to the low end of the range as we approach contract expiration here in May, you're talking about a $25 move. So to your point, Michael, we are running contra-seasonal, right? We're seeing highs in the May feeder cattle contract while the seasonal should be actually running lower. So That's the May feeder cattle contract. Looking at September a little bit further out, same sort of seasonal tendency. You get the same peaks within the February time period and then the early April period. You'll still get that seasonal low as you march into May, around May 20th to the 26th. But then you get a rally that hits the high period around August 9th to August 10th. What does that mean? It means you have some opportunities to employ some sort of risk management around those peaks or around those lows to take advantage of any kind of protection that you want to employ for the feeder cattle contract. If we look at the live cattle markets, we can take a look at June seasonals, very similar to the feeder cattle approach. You get the highs, again, February 16th through the 22nd, and then it'll move into its seasonal low, June the 4th. Again, the opportunities to employ some sort of risk management are at those peaks. So we wanted to look at those kind of that mid-November period. We want to look at the January 4th period and mid-February period, as well as March. It's not near as high in March, but again, you want to take advantage of those opportunities to employ some sort of risk management, whether it's LRP or using future and options, just to take advantage of those high periods. We can also look at some form of technical analysis. I like to look at the Williams %R or the slow stochastics, just again to try to find those overbought periods that align with those seasonal tendencies. And what that does is that gives you a little bit better chance to get into the high point of the markets. Going out just a little bit further, we can look at that October live cattle contract. And again, it moves in tandem with that June contract, albeit a little bit longer. You still get those highs around February. You're going to move into that kind of that lower period within the June time period. And then you're going to get that same rally that you saw into the August 5th time period within that contract.
Stephen, thank you so much for talking us through those seasonals. It seems that, especially with the May feeder cattle contract, we are rallying contra-seasonal. I hear you say rally a lot in terms of these seasonals, and that seems to be exactly what this cash market is doing, is simply just rallying contra-season to where we're at in the calendar year and in the cattle calendar, if you will. We can see this all over the cash prices. We've got northern feeders selling at 221 to 198 within the 700 to 900 pound range. We've got southern feeders in the same weight class that aren't too far behind in the 201 to 182 range. Northern live cattle are simply on fire. We've seen a spike higher in cash. We've got live cattle trading in the north at 178 live on the hoof and then 278 dressed. Just simply outstanding numbers. There's an article headline I saw today called "Cattle Feeders Are Holding the Stick," and that is absolutely the case. We've got southern live cattle just a few dollars behind that, trading at 172. So going forward, how do we make heads or tails of this? In normal years, seasonals are going to help producers time selling opportunities and likely find buying opportunities. But when the word is rally and when the market seems to be doing just that, this is a counter-seasonal trend. Finding replacement calves, finding replacement feeders, it's just simply going to be expensive. When we talk about risk management, we often talk about hedging the sale of our cattle. At this point, it's well worth it for a producer to consider hedging the cattle being bought, because again, counter-seasonal trends, this market, whether cash or futures, seems to be just red hot at the moment, and that replacement inventory is simply going to be expensive. When we talk about hedging cattle being bought, the easiest way to do that, obviously, is going to be with futures and options. But Stephen is actually going to tell us of an insurance policy that you can hedge your cattle being bought in. This insurance policy is called Livestock Gross Margin. And if you've never heard of LGM, it is Livestock Gross Margin Insurance, which is essentially your live cattle price minus your feeder cattle price minus your corn price. Stephen, why don't you take us through some seasonals for LGM?
Yeah, thank you, Michael. I appreciate that. So we do have seasonal patterns on livestock gross margin as they apply to both swine, cattle, and the dairy space. Well, within the cattle market specifically, they break them up into two components. It's cattle yearling finishing and what they call calf finishing. I'm going to look specifically at livestock gross margin seasonal specifically for yearling finishing for the June contract month. And what we see here is we actually see the price increase all the way into January, basically mid-February, just like you'd see in the live cattle and the feeder cattle seasonality. And just realize again, the LGM is made up of three components, right? It's the live cattle price. You're backing out the feeder cattle component 5 months prior, and then you're backing out the corn component 2 months prior. So there's three different components within the seasonal, but it makes that peak primarily off the live cattle tendencies to climb into February. And then you see a rapid fall off as you move into that April time period, where then the contract expires towards the first part of June. So, that's one of those things that we can certainly use LGM seasonals to our advantage to try to target those periods that we want to insure, right? So if you're looking at that June contract or that June time period, you would actually want to be trying to purchase coverage for this policy around the January to the February time period to get at that highest level of coverage, because we know that there's a good tendency for that seasonal pattern to fall off as we move into the expiration of that period into June.
Very good. Thank you, Stephen. That is a wrap for today's episode. Thank you all so much for viewing Pasture to Pen. Thank you, Trey. Thank you, Stephen. Thank you, Paige. Thank you, Corey. And a big thank you to our entire Ever.Ag Insights team. We always have fun making these episodes. If you haven't already, please hit that subscribe button, hit the alerts button so we can keep you up to date. As always, stay safe and pray for us.